Hi traders, welcome to this week's Market Outlook, trends, risk, events and trade setups brought to you by Vantage Markets. This is a weekly webinar where we focus on generally what's been happening in markets and what's about to happen in the week ahead. Whilst I'll just let you have a quick look at the disclaimer. Um, obviously, we are into the holiday period now, really, for this week ahead. But there has been, of course, a lot happening in markets over the last week or so. Yeah, the next 30 to probably 30 minutes or so, actually, we'll just follow the standard format again, just because we'll just check out how stock market indices are looking after the big sell-off, obviously, after the Fed meeting last week. So it's worth looking at the technicals around those. As I say, it is the holiday period. For us, that means, of course, a lot less liquidity, but it does mean you do get volatility. So you do get some trading opportunities, although sometimes you can be left scratching your head because the reasoning for the moves is really not very apparent in this holiday period, we would say, and that is from a lot of experience that we've had over many years. So yes, what we'll do in the this webinar, of course, we'll just check out those markets, stock markets. We'll just check out a couple of points from last week as well. Some interesting points we always try to highlight to you, as well as touching upon the Santa Rally, actually, which well, we'll just get into just sort of strictly what that is actually and the time period for that, and just highlight the sort of key points from that before then looking at the main events from last week. So some major central bank meetings, of course, the Fed, the biggest one. We'll go into that in some detail, just review what happened there, and then also the market reaction, of course, which was very instinctive and really sets us up for the new year for sure. We'll look at the Bank of Japan meeting and the Bank of England meeting as well as looking at dollar yen, cables, so sterling against the dollar, and a couple of bits of UK data as well, which were out last week. We also had PMI data, actually, which was interesting, which set us up for those central bank meetings, actually. And yeah, that'll be the main review of last week. As I say, huge meetings by those central banks. We always get them sort of mid-December, just before the festive period, really. So yeah, we'll concentrate on those, and then just briefly have a look at a couple of bits for this week. There is the RBA meeting minutes, which could be of interest, actually, because of this slight change in tone by the RBA, by the board, slightly less hawkish. Then we'll pretty much wrap it up there. We'll just run through a couple of other data points possibly over this week, before then wrapping up. We do have another webinar actually before the end of the year, so this is the penultimate one. We have one next Monday as well, where we will just run through a few other bits of data coming up that for that week ahead, actually. So there'll be for that week ahead, and then also we'll just I think we'll run through some of what consensus is looking at for next year, 2025, and we'll go through some different asset classes and look at the charts on those as well. So we'll look at bonds, the 10-year treasury, we'll look at stocks, we'll look at the dollar, of course, and then also oil and gold as well, and just see what a lot of consensus thinks, which is really instructive for us because at the moment they're all pointing very much one way, which does well, especially for us, leave us thinking that there will be some volatility, because what happens is when there is a lot of crowding around core themes, the same core themes, and that tends to exaggerate the scale of market reactions, certainly when stuff goes wrong. So yeah, that's the kind of sort of area and viewpoint that we'll have going into new year, as everyone, it seems, portfolio managers, fund managers, are really focusing on US exceptionalism. And that is something we bring out actually in our review and preview of the year, which hopefully will be published, I think, pretty soon on the website and across our social media as well. I should say as well, if you do have any questions along the way in the next half hour, so please do ask them any question, however big, small, whatever you're looking at, or whatever we're talking about as well. Please do ask questions. Okay, just Yeah, we'll just check out markets generally. Asian stocks open firmer actually across the board, following the lead from Wall Street. Actually, holiday thin week as we've said, so just watch out for the sort of unexplained moves due to less liquidity. The U.S. government did enact a budget to avert a shutdown, but the deal. I don't think it does include President-elect Donald Trump's proposal to raise the Fed borrowing limit. Dollar, that's bid actually to start this week. Quiet news flow generally. Gold is firing some buyers amid a dollar bid. And European equities pretty subdued really after that decent actually close on Wall Street on Friday. So nothing major to talk about. If we just pull up first of all couple of charts, we can see Friday, sorry, post the Fed sell-off, which we'll look at in more detail, as I say, shortly. And then we just had this decent rebound on Friday. This is the S&P 500 daily chart. So you can just see we've got a fib level in from the lows in September. You can just see the 38.2 retrace level at 58.33 there. Just bounced off that quite nicely, and we're up to now the 23.6 fib level, minor retracement level, really. That's at 59.35. So yes, all really down to the Fed, as I say, the hawkish cut from them, really generating quite a bit of volatility, really. Equities sold off, yields surged, the greenback strengthened in a nutshell, and risk appetite really certainly waned. Tech took a lot of the risk off move, although some certainly took it as an opportunity to buy the dip. And of course, sentiment hasn't been helped recently, or just last week, with this threat of the government shutdown risk. But that sort of abated slightly now. On Friday, we saw that decent dip buying and strength in, well, the wider indices, although tech lagged the Dow and the S&P. Last week as well, we did see actually interestingly crypto sort of lose that momentum in the risk off week, really. So buying momentum in, well, Bitcoin and other major cryptos actually seem to have stalled. Market sentiment remains cautious. And it was further dampened actually by Fed Chair Powell's dismissal, really, of a strategic Bitcoin reserve initiative. US Bitcoin ETFs, so that's exchange traded funds, they saw record outflows, 680 million on Thursday, the 19th, according to data compiled by Bloomberg. And crypto exposed shares really also experienced steep losses. If we just look at Bitcoin briefly, we don't look at it too much, but obviously we had those record highs at 108,000, above 108,000 last Tuesday, and then we've just dipped off that. It would look like major support probably is around 91, 92,000 or so. You can see those lows there, and we've sort of seen buyers return around that level. So yes, whether we dip down to that, then potentially we could get more losses if we break through that sort of 91 area of support. Otherwise, as I say, expect markets to be pretty quiet. Holiday period, that disrupts trading, and liquidity is thinner, but as I said, it can incite really some volatility. If we just look at the other stock markets as well, excuse me. Yeah, you can just see the buying in the Nasdaq after that sharp sell-off through the 21-day moving average. That's that grey line. We haven't quite tapped the 38.2 retrace, which is at 20,707. So we're back up to the minor retrace, the 23.6 at 21,252. So interesting whether we can keep above that. The Dow, of course, that suffered those incredible amounts of 10 straight days of selling. And then that huge day, obviously, after the Fed. 10 straight days we haven't seen for, I think, since the 1970s, incredibly. So we bounced off this grey line, which is the 100-day moving average, actually. So that's a 42,274. We did spike up to the sort of halfway point of this near-term fib level 43,360. Just we didn't get quite up to there, but then we pulled back down to, well, these lows from from the election actually. Well, the gap higher in the election actually, and the open, which was at 42,850. Where do we close? 42,840. So interesting whether we keep that 100-day moving average in the Dow, or we lose that, and then we've got 41,647 below that, being these lows from early November. As I did say, we'd mentioned the Santa rally. Well, according to the Stock Traders Almanac, which is essentially, I think, who sort of looked into this phenomena years ago, they basically say November is the start of the best 6-month period for US stocks. It's been the best month for the S&P and the second best for the Dow since 1950. And it's been the second best month for the tech-heavy NASDAQ since 1971. But when you dig into the finer details, really, the Santa rally actually refers to, well, markets increasing in value, specifically during the last week of December and into the first 2 trading days of the new year. That's if we're getting into the finer detail, as I said. But research shows that since 1950, this single 7-day period has produced a positive return for the S&P 500 at 79% of the time. And they say actually that no other similar duration of trading sessions is more likely to be higher. That's this kind of Santa rally if you're getting into some nitpicking about the actual specific time of that rally. So that means we still have time for it. But interesting, obviously, yeah, we've got a few support levels, quite big support levels, really, which we would like to see hold if we are to get this push into the last few trading days of the year and the first couple of 2025. Okay, let's now move on to, as I say, last week's main events, of course, the central bank meetings, major central bank meetings with, first of all, the Fed, then we'll look at the BOJ, and then the Bank of England. Got a couple of graphics. We've got a couple of charts as well after this graphic. We've just updated it from last week, so kept a couple of the numbers, but of course, they cut by 25 basis points as expected. But the broader policy message was certainly more hawkish than expected. So the new dot plots and projections were heavily revised, now only factoring in 50 basis points of additional easing in 2025. And one FOMC member voted for a hold. If you remember from last week, general consensus, I think, was for 75 basis points of cuts from 100 basis points of cuts from the September median dot plot. Now only 225 basis point cuts essentially rather than 3. That was a surprise, and really policy was said to have entered now a new phase, and barring major downside data surprises, the Fed expects a slower pace of rate cuts starting from January. The updated median dots now project only a single 25 basis point cut every 6 months for the next 2.5 years. And the 2026 median dot, that rose to 3.4% from 2.9%, and from the expected 3.1%. And also, while we're at it, the longer term dot was raised by 0.1 percentage points actually to 3% now. So we had growth and inflation forecasts. They were revised higher. That's really what booted the dot plot to rein in those rate cuts that the Fed now sees as their median dot plots. Chair Powell, he stated the decision was the right call and the risks are two-sided. And well, interestingly, there is still a wide range of views, with one official, as we said, seeing no cuts in 2025, one predicting 5 25 basis point cuts. That kind of doesn't fill you with huge sort of conviction, really, even though, of course, yeah, there is this big change in the median dot plot. Chair Powell, he said that the Fed will be more cautious moving on and that more progress on inflation is needed for further cuts. Remember that the dovish shift by the Fed a few months ago was triggered by concerns about the jobs market, whereas last Wednesday, Powell basically said the risks to the labour market had diminished, effectively removing any sense of urgency, actually, when it comes to easing. So yeah, really interesting meeting, really interesting change in that median dot plot, and of course then these revisions higher in growth and inflation. Just on a couple of these charts, which we thought were interesting, we had the biggest market reaction in the US Treasury 10-year yield since 2013. You can see that there. That's on an FOMC day. And we can show you that chart shortly. Actually, the 10-year US Treasury yield, you know that we call it the proxy, really global proxy for borrowing costs, or proxy for global borrowing costs, essentially. So that's why we look at it, and then that moves most other markets, including the dollar, of course. And then we also had this chart here, which has trying to show you really there's just this much shallower path of rate cuts now. You can see from January onwards, from December really, you can see previously in September we had rate cuts taking rates at the end of next year to below 3%, and now you can just see there's basically 50 basis points accounted for across next year, and that leaves the Fed funds rate for the end of next year just below 4%. And if you would just go back, you can just see, 50 basis points then of easing in the median dot plot. And in fact, markets see only around just above 40 basis points priced in now. If we just show you some of the market reaction. First of all, and I know you will have followed it yourselves, but yes, you can just see this big break higher out of bullish consolidation. Few days of just tracking sideways before that Fed meeting there. I'm just highlighting here, so that's bullish. A bullish flag really before bullish consolidation, tracking sideways before big break higher, which we got obviously on the Wednesday, broke through 107.34, which was that high from October last year. And then actually broke through the previous high from late November at 108.07. We had been highlighting, and we pushed up to 108. Where do we go to? Last Friday, 108.54 before a sell-off, but still stuck above that 107.34 level, key for us. So that means we're just going higher potentially and going to break that 108.54 level at some point soon. You can just see if we go to the weekly next levels above that, probably this spike high here from July 2022 at 109.29 possibly, and then we've got levels around sort of and above 110 possibly. We are getting towards overbought territory on the weekly. The daily as well, we've just eased back, so that's kind of healthy before it looks like bulls may go for that high at 108.54. Interestingly, and we had said previously in the last few weeks that generally you do see seasonality, dollar seasonality, meaning you get weakness in the dollar around this period, but at the moment, of course, that looks quite unlikely. Stocks, and I've highlighted that already, but let's just show you the moves in a little bit more detail as well. For example, you had that big sell-off in the Dow after those consecutive days of losses as well. Both the Dow and the S&P saw their biggest one-day percentage drop since the start of August, actually, and the Nasdaq suffered its biggest one-day sell-off since July. 10 consecutive days of declines in the Dow. That's the longest streak, as I mentioned, since October 1974, actually. And then, of course, we had the big move in the dollar, and that was brought about by the big move in the 10-year Treasury, which you can see here. If I just pull this back, just checking. Yeah, we've got fib levels in here, just checking which ones from their long-term fib levels, actually from the 5% level down to the lows in mid-September, around sort of 3.6%. This is the 10-year US Treasury. And you just got that big break higher, so break above the November highs, and now we're sort of got up to, where do we get up to? 4.59% or so, so above the 4.5% sort of kind of psychological level. That fib level tallies the 61.8 or 4.47%. So yes, interesting whether we can keep above that and the sort of 4.5% level. If we can, then potentially we look up to 4.63% possibly, and then these highs from April of this year around 4.73%. That's the year-to-date high, and that would certainly, you would think, help the dollar break those highs as we've mentioned, and then possibly see stocks move lower. Was interesting because obviously many factors seeing this push higher all this year, obviously in stocks, but then a big sell-off. Lots probably looking for a reason to just pocket some profits, of course, but also potentially rate cuts have, of course, supported risk markets as well. And that means, of course, if we get less rate cuts, less policy easing by the Fed, then potentially we could see stocks slightly struggle into the new year. Okay, next we'll look at dollar yen. We'll look at the Bank of Japan meeting. Here's dollar yen, which is really governed by 10-year US Treasury yields as well. So if they go higher, then dollar yen goes higher, pushes the dollar higher, pushes the yen lower. A lot to do with, of course, interest rate differentials here. And that just means the differences between the US rate and, of course, yen rates. And really, this move was, as well, you can see a big move higher in dollar yen on Thursday. That was after the Bank of Japan. Basically, they delivered a rather cautious hold, really, which disappointed a lot. Possibly some looking for a hike even, but really it was a dovish surprise by the Bank of Japan. Consensus, yeah, we were looking for a hold, I guess, but probably expecting more openness towards a hike in January. Governor Ueda, he's sounding more data dependent than forward guidance orientated, pretty much saying additional information on wages and growth is needed. In fact, for the next hike, he said he needs one more notch to decide on tightening. And even though, well, we'd highlighted actually the economic recovery in Japan really looks on track, real wages have at least stopped falling and inflation is close to target. So there is that case for hiking rates. But really, as well, the press conference increased the odds of rates being left unchanged at the January 24 meeting, with more focus on the March 19 meeting. Really because of additional information on wages actually won't be seen till probably the spring wage negotiations, which will only start filtering really through by that sort of March meeting. So rank disappointment really with the Bank of Japan, Governor Ueda being rather more dovish than expected. That saw, as I said, dollar yen pushed higher through 154 on the Fed, and then after the Bank of Japan, it made new highs, cycle highs, actually breaking those mid-November highs at 156.74. You can see on Friday we got up to 157.92. And really, it looks as though if we can hold sort of around here, just above these cycle highs, then potentially direction of travel is towards a sort of 158, 160 area. Of course, that is the area, the zone where the Bank of Japan sold close to $100 billion actually this year. Previously, successful attempt to stabilize the yen. So yes, potentially we're getting into intervention territory again. You can see, of course, the high actually was at 161.95, that multi-decade high, before we plunged very sharply lower in a matter of a few weeks down to sort of below 142 from 161.95. So just interesting whether we get up through 158, possibly in the next week or so, then possibly You may get some intervention, verbal intervention before possibly some kind of physical intervention. Certainly, if we got volatility around the holiday period, then yeah, would be interesting to watch that volatility and potential trading opportunities. Just on yeah, intervention. It's interesting, actually. Kind of presume that the incoming U.S. Treasury will probably not mind intervention, given that Japan will be trying to support its currency. So just yeah, we'll be on the lookout for that over this holiday period and possible trading opportunities. If they come up and we get a spike higher, possibly in dollar yen before that. Okay, we also had Bank of England meeting. Again, we're just using the graphic from last time, but just updated it slightly as well. So the Bank of England, they opted to hold the base rate at 4.75%. That was expected, of course. The main surprise, though, came from the vote split. We'd expected 8-1. We actually got 6-3, so 6 on hold and 3 advocating for a cut on the MPC. The dissenters really, they pointed to sluggish demand and a weakening labour market, both of which would see downward pressure on demand, wages, and prices. But then the majority, they saw CPI, wage growth, and inflation expectations having risen, adding to the risk of inflation persistence. For what it's worth, Governor Bailey, he noted that the MPC cannot commit to when or by how much they will cut rates in 2025, quoting him actually. And as such, the statement reiterated guidance that a gradual approach to removing monetary policy restraint remains appropriate, which is what we've obviously highlighted here. He also said that policy will need to continue to remain restrictive for sufficiently long. Of course, if you remember, the ECB took out essentially that phrase they had, Bank of England's keeping it in. So they're highlighting really this gradual approach. And then again, some members pointing out about inflation persistence, which we've obviously heard from them before. There then it really seems to be then a clear rift actually now, but within the MPC between Doves, who are concerned about slowing activity data, and then Hawks, obviously, as I've just said, who are focused on stubborn services inflation, sticky wage growth, and really inflation persistence. A February rate cut then, that is seen around a coin toss, I think, from sort of 40, low 40% or so pre the Bank of England. And then there was around 53 basis points of easing seen by next year end. That's from sort of below 50 basis points before the Bank of England meeting. As I say, yeah, odds are around 50-50, just below, I think, for a February rate cut. Just to highlight as well, we did get a couple of really important data points out of the UK. So we had inflation that surprised slightly to the downside in November, but it did overshoot the Bank of England's forecast. So headline that came in at 2.6, consensus was 2.6. And the prior was 2.3, but then the more important core number, 3.5% that printed out. Consensus saw 3.6, prior 3.3, and then services that printed at 5%. Consensus was 5.1, prior was 5%. So while service inflation momentum slowed, interesting, a number of economists actually point out core services, so that excludes volatile components, that increased slightly after edging lower the past few months. And that is the key worry for the Bank of England and the MPC. Really, services inflation is likely to stay around 5% for the next few months. And then that does still argue for this gradual approach from the Bank of England. We also got actually labour market data as well, and we saw a jump in wages actually with ex bonuses rising to 5.2% from 4.9. So again, a worry for the Hawks on the MPC. If we just look at cable now. So dollar sterling against the dollar, of course. Struggled really, of course, on that Fed meeting. Looked as though we could be sort of hanging around the sort of 127 level or so, but the Fed put paid to any sort of rally against the dollar, essentially. So dollar got bid up and cable fell, of course. Now we're down to these levels from November, just above 125. You've got a minor fib level at 125.41 or so. And we're just hanging around here, but these lows look as though they're going to be challenged. 124.86 is that November low. Where do we get to on Friday? 124.74 actually. So just below there. If we do break decisively through here, then certainly we'll look out for this low here from May at 124.45, and then obviously this big low from April at just below 123, 122.99. That's in cable, but it looks as though certainly bearish momentum is resuming, and certainly if we break down through that 124.74 level. We also had, I should mention, PMI data actually last week as well. December surveys, they gave some relief for the growth outlook as services PMIs actually rose more than expected, both in the US, Euro, and in the UK actually. They bounced back above 50 in the Euro following the large decline in November. Possible sign activity is holding up, while the US services PMI rose further actually to 58.5 from 56. In contrast, though, we should mention activity in the manufacturing sector weakened in the US and in the UK, actually, while the euro remained unchanged. If we just look at euro dollar, actually, which we haven't done, so you've got that low, which you got close to the November spike low, 103.31, just bounced off there, but we stayed below this key number for us, which is that October low from last year, 104.48. You can see that big dotted line, so that's major resistance for us. And then if we're still below here, then we'll challenge 103.31 and probably break that at some point soon. And then that means we get down to potentially looking at some lows here around 102.22, and then below that we've got this dotted line, which is obviously parity. A lot of Wall Street FX strategists, they see euro dollar going to parity through next year. Just to highlight that for you, and we'll probably go through some of that next week as well. So that's euro dollar. Otherwise, that's all from last week. If we just want to pull up Aussie dollar, we do get this week, then I mentioned the RBA minutes from the December 1st meeting overnight tonight, actually. So really we'll be watching for any sort of dialogue around any sort of inching closer to easing, since the next meeting isn't until February 18, actually. Any hints around that would be market moving potentially. And the reason to expect as much is that the statement from December really noted several things that sounded less hawkish, if not more dovish, really. They said some of the upside risk to inflation appeared to have eased. The board is gaining some confidence that inflation is moving sustainably towards target. And they also then deleted that reference, if you remember, about sort of two-way risks and not ruling anything in or out, I think is how they put it. So potentially that rules certainly the risk of any further tightening. And that means actually, of course, markets priced in the potential for a quarter point cut at the February meeting, around 60%, I think, chances of that happening. So really, these minutes could be seen as potential confirmation for that. And the Aussie may struggle again. It is oversold. You can see suffered really badly after the Fed meeting, of course, breaking down through that previous low at 63.47, really. And now we've got this level below 62 from October 2022, that's now at 61.69, that dotted line. So that's a key level now. If we do break down again through the low from Thursday last week at 61.98. Otherwise, I'm just checking out the calendar really, any other data points we get. Consumer confidence out of the US. I think today actually, and that's expected to rise. And then tomorrow we do get durable goods out of the US. They're expected to soften given weak aircraft orders. Otherwise, just minor lower tier data, really, new home sales and weekly jobless claims and pending home sales as well. Japan, for what it's worth, that delivers actually its monthly data dump just the day after Christmas Day, that is the 25th. So we get fresh Tokyo CPI inflation gauge alongside retail sales and other data points as well. And we do get China update on its purchasing managers indices on December the 30th. That is next Monday, of course. Okay, yeah, we previewed the quiet week just there. So we'll wrap it up for now. We will be active on social media through the holiday period, the festive period. We will be putting out a daily commentary after the US close tonight, actually, but that might be it for this week. But then, as I said, we will have another webinar same time next Monday, and then carry on with our daily commentary mainly from next week. Please do follow us on all these channels, and as I say, we have a daily commentary generally put on the website after the US close with a chart of the day and a look at the day ahead. As I say, only one overnight tonight, UK time, and then the following one will be next week. Take care out there. Have a great holiday period and rest up or yes, take it easy, and we will speak to you same time next week, just before year end. Okay, all the best.